Hello there, Pursuing Freedom friends. This is your host, Erin Bradley. Thanks for tuning in today. If it's your first time here, we've got a great show in store for you. And if you've been listening for a while, I think you're going to leave this conversation very inspired because I've got my new friend, Kevin Bupp, here. And Kevin is the author of a book called The Cash Flow Investor. He's also the founder of an organization called Sunrise Capital Investments. And he has a wild story about falling into investing at the ripe old age of 19 and how he went on to build an investment portfolio and then lose it all in 2008, only to build it back better and smarter in one of what he refers to as the most boring asset classes possible. And the reason I wanted to bring him on the show is because for many years on the podcast, we've spent a lot of time talking about strategy inside the operational side of our business, right? Everything from mindset to systems and scale and strategy and all the things. But from a bigger picture perspective, why did we become self-employed? We wanted some kind of freedom and flexibility, right? Hence the name of the podcast, Pursuing Freedom. But what does freedom look like? I mean, I remember not feeling very free when my credit card was being declined for a $2 cup of coffee. And I also remember not feeling free when I was tethered to my phone working 24/7 in exchange for making good money. And so there's got to be something more than just how to get your next transaction and get your next lead and get your next paycheck. And I know that many of you listening have been either selling real estate or doing mortgages or investing in real estate for a very long time. And I think we're all after the same thing, right? And so that is what Kevin has been after as well. And he's really mastered and created an opportunity for others to jump on the train and get in the game with him. And so there's so much we're going to unpack today. So with no further ado, Kevin, let's start from the beginning. And thank you so much for being here with us today because I love your story.
Yeah, thanks for having me, Aaron. I'm excited to be here. So let's do it.
Yeah, so bring us back to the beginning. I mean, the fact that you started, I think real estate investing at 19 years old is insane in and of itself. But give us the whole rundown and then let's unpack it from there.
Yeah, I'll try to keep it short and sweet. But I mean, I actually bought my first house when I was 20. Got introduced to the game of real estate at 19. But it was really I always joke and say real estate found me. I didn't find it. And I'm really grateful that point in my life happened because I wasn't really academically driven in high school. I kind of just like literally skimmed by, barely graduating and not necessarily knowing what I wanted to do when I grew up. I was always an entrepreneur as a kid. I had a paper out at 12. At the age of 14, I learned how to install car stereos and amplifiers, and I did it in my brother's friends' cars, like all of his friends that were driving at the time. We use my parents' garage, install stereos. I'd mow grass in the summer. I'd shovel snow in the winter. I did whatever I could to kind of make my own money, so I could buy the things I wanted, the things that I felt were cool as a young teenager, right? But then making it through high school, I didn't know where to apply that energy. Entrepreneurs wasn't necessarily, it wasn't an accepted term back then. It wasn't an accepted field of work. Obviously there were business owners, but being an entrepreneur, it was kind of laughed at. There was no curriculum around it, and so it was a either you go to college, or you just succumb to getting a service-based job. I don't know, go work at UPS, go be a plumber, go be a electrician, all great things, but I didn't want to do any of those, and so I just didn't really know where to apply my energy. And so anyway, I did what most 19 or 18-year-olds would have done is I went and got a job bartending, worked at a restaurant so I could have some fun while making money. And I did that for about a year and a half. And during that time, I met a girl, and that girl had her mom had just been through a divorce. She started dating a local guy, and this local guy was David, and David happened to be a local real estate investor. I mean, like again, just the stars aligned, and I met this guy David, and he seemed to just live a very different lifestyle. He kind of had a different swagger. He drove a very different car than what my parents drove growing up. I grew up in a very much a middle class family. Both my parents worked full time. We didn't go without, but we didn't have a lot, right? It was just a typical blue collar, middle of the road upbringing, and it was great. There's no complaints there, but we just didn't have a lot of extra money. There was always conversations around finances and could we afford to go on vacation that year and things like that. But I met David, and it just was very different. It was my eyes were opened up a little bit about some of the flexibility he had in his day to day. I'd see him out like on a Tuesday afternoon at visiting my girlfriend's mother at their house, and that was shocking to me. I'm like, that's kind of the time of the day when people that age are supposed to be at work, right? Working their 9 to 5. But long story short, I became friends with David. Got to know him quite well over a couple of months, and didn't really understand what he did other than he owned rental properties and he had tenants that paid him. And I just hanging around him, and through osmosis, I got to learn a little bit more about him and what he did. And He invited me to a conference down in Philadelphia, and I graciously accepted, and that's where it really all kicked off. And I went to that conference at 19 with him, attended 3 days, and met a lot of people that were doing what I thought were huge things. You know, I was surrounded by people that were, it was mostly wholesaling homes and fixing and flipping homes. That was kind of like the curriculum of this the seminar. And but these folks were talking about flipping and making $15,000 checks, $20,000 checks, $30,000 checks, or met a guy that had 40 rental properties and was making $20,000 a month in passive income. And like that was just mind blowing to me. And what I left with was an understanding that there was a way, and that I didn't feel a lot of these people were smarter than I. They just knew something I didn't know. And but David was my answer to that. And so I went back and I made David an offer he couldn't refuse, and that was let me come work for you for free. I was taking classes at community college. I had like 12 credits, so I wasn't super busy with my college classes. And I worked in the evenings. I worked mostly like Thursday, Friday, Saturday nights, and so I had a lot of free time during the work week. And he accepted. I went and worked for David for free, doing anything he needed. He was kind of a solopreneur. He didn't really have an assistant. And so he was good at a lot of things, but sucked at others. He was really bad at returning phone calls. He was bad at, dropping leases off in a timely manner and just simple like admin tasks. And so that's what I became for him. And I did that for about 14 months. And I did that probably about 30 hours a week. And I learned a ton. I got to listen, how he said it, who he said it to, why he said it, right? I got to be around him during every interaction that he had, any conversations he had, negotiations. And so by the age of 20, I was in my mid 20s. I felt confident enough, and I had some money saved up from tending bar, that I went and bought that first investment property. And that's really where it all started. And I just continued forward after that point in time. And I just really built upon what David taught me. And I didn't try to reinvent the wheel. At that point, I didn't know what I didn't know. And so what I did know is that David's business model worked. It was pretty simple, was to buy property, at a low basis, at a significant discount from motivated sellers, put repair capital back into it, and then essentially rent it out. Mostly what he did was buy and hold. My only modification to that was that I couldn't necessarily just buy and hold and build a portfolio because I didn't have much capital I was working with. So I had to, I'd buy three homes, flip two of them, and then keep one. Buy three homes, flip two of them, keep one, and I did that, and I did start doing that scale in my early to mid 20s, and that was really the first foray of my business, and I did really really well, leading up to '08, and '08 reset pretty much everything, lost everything over a 2 year span of time, and 2011 kind of jumped back in the game, and by 2012 was buying property again, and started rebuilding the infrastructure of what now is Sunrise Capital today. A very different looking organization than what things look like back in that, and I guess in that version one of my investment phase. Really build it a little bit more intentional with the idea that it would be sustainable no matter what happened in the economy, no matter how many ups, how many downs happened. And as you and I were talking about here, about just the last couple of years with kind of the blowback in the marketplace, the capital markets are all messed up, and rates are at all time highs, transactional volumes at all time lows. We literally had two of the best years ever in 23 and 24, when others were struggling to do deals. So
As you were building your real estate portfolio, how was it different than it is now in terms of logistically speaking? How much were you needing to put down when what caused you to lose it all? If you were flipping two and holding one, was it that they stopped cash flowing? Was it that they turned upside down? Were you on adjustable rate mortgages? Like, bring me back to that because I'm kind of
yeah,
curious what the journey looked like.
I'll give some more context. I started investing in Pennsylvania. I moved down to Florida. I was born and raised in Pennsylvania. Moved down to Florida at the age of 22 back in 2002. And this was during kind of the upswing. Lots of growth happening in the Tampa Bay and surrounding regions. And my business had already kind of morphed into more of what David was doing. By that point in time, I'd already invested for a couple of years, had built a portfolio of private lenders. And so personal capital wasn't necessarily the problem anymore. As soon as I could stop flipping properties, I stopped flipping properties because again, I was trying to find a somewhat of a non-transactional way to like continue to build this wealth and have it compound on itself. And I just saw, the flipping homes was great. You make big pops of money, but you also big capital gains. You pay short-term capital gains, and I just saw that as a I got to start my job again January 1st every year, right? Like, and it's a lot of work to flip homes and be successful at it. And so as fast as I could, I started holding every home that I could. I would basically go buy, just to keep it simple, I would go buy 3 to 5 homes a month. Sometimes much less than that, sometimes more, but I was buying about 30 to 40 homes a year, give or take, for a number of years. And I would go buy them with private money. Local high net worth individuals that would act as a first lien holder. They would finance the repairs as well. I typically be all into these things for 70 cents on the dollar once they were fully repaired. And then I would go to a local bank. I had a number of relationships with local banks, and I would, cross collateralize 5 of these single family homes, do a cash out refinance, pay back my private lenders, and then have a, typically it's a 5 year term, maybe 20, 25 year amortization on these package of 5 homes. And so I would just kind of rinse and repeat, rinse and repeat. And the biggest thing, there was a couple things that really crushed us down. So this is in Florida. This is where the portfolio was being built at scale. Is down here in Florida. There was a couple factors. This looks different than what it does today. Number one, the economy in Florida wasn't as diversified as what it is today. This is back when there's, lots of spec homes being built. Florida and California and Las Vegas and Phoenix, like literally Florida, the entire state, at least the major markets in our state, as well as like Phoenix, Arizona, Las Vegas, and a number of markets in California, became ground zero for spec builders that were fueled by all these, crazy subprime loans that were being put in the marketplace, right? And so down here, a couple of the big challenges that I faced was there were, tens of thousands of new homes being built for populations that weren't necessarily here yet, that weren't coming, supposedly coming. And so that was one thing. There was a oversupply over a period of like 4 or 5 years, a massive oversupply that took place in the same markets where I already own rental homes. The second part of that is when everything kind of crashed, essentially all the jobs went away. A lot of the jobs were fueled by real estate, lots of construction jobs, anything that revolved around real estate was no longer. And so people had to move away to go find work other places or try to find other career paths. And so that was a challenge even with existing tenants, right? Like people lost jobs, people didn't have jobs, people didn't have income. And then lastly was that as a result of the oversupply down here, everyone says rental rates never go down. Well, that's bullshit. It really is. I mean, if you look at a long-term trend, maybe that's not the case. But if you look at it on a much more of a short-term scale, maybe over a couple year span of time in select submarkets, you'll find that down here in Florida, we had many markets where rental rates went down 15, 20%, maybe even 25% over a period of a 3 year span. And basically all those ingredients kind of paired together is what really crushed me. So I had a much harder time leasing up our units. I had to basically offer rent concessions or massively discounted rents in order to get people into my units. And then the people who are getting in my units were of a less quality now, right? Because people were struggling with their employment and just having steady streams of income. And so I went from being on average 98% occupied across my portfolio down to about 80% in a very short period of time. And as a result of that, what used to be positive cash flow now was negative cash flow. And so that was a big factor. But then there was a couple other things that happened in those couple of years. We had a couple major hurricane years down here. One of the years where it literally impacted about 30 of my homes directly, like literally ripped roofs off. And while we might have come out not necessarily ahead, but a lot of those things, insurance paid for new roofs and repairs and loss of income. But guess what? The following year, the insurance rates doubled or tripled, right? Which it completely crushed cash flows. So like, there's all these elements that kind of came into a play like a perfect storm, all around the same period of time. That just it got to the point to where I was, instead of cashing checks of positive cash flow, I was writing checks to make up the deficiencies on a monthly basis. And the last kind of nail in the coffin was down here when the market crashed. We watched the portfolio, the valuations of these homes literally drop in some of these submarkets. They literally dropped within 2 years, 50%. Of what their peak value was. I mean, it was so basically not only was it negative cash flow, but these things were, I had a low basis on them, but I was still negative value, negative valuation. And at that point, when all this happened, none of the banks, they weren't prepared for this onslaught of delinquencies and foreclosures and defaults. And so they didn't really have the staff or the personnel to manage for the first couple of years. Now, as the downturn kind of played on for a number of years, they had to build entire teams, loss mitigation departments, loan modification departments. Like they literally had infrastructure they had to build out. But like the first like 12 to 18 months, a lot of these local banks that we have relations with, they were not prepared. And so really their only recourse was we're calling the loan due. Like your debt service coverage ratio is you're not meeting the loan parameters, and so we're calling your loan due. And I didn't literally we didn't have any ability to make these things whole, and a lot of these banks weren't willing to work with us on modifications, and so it was a challenging time, and it got to the point to where we just had to make a strategic decision where it was give the keys back on a lot of these properties, because it was to the point we had no money left. We had paid all we could out of personal money to try to keep these things afloat. Lost my personal residence, all my credit got shut off. All my personal accounts got shut off. Bank accounts got garnished. I mean, it was an ugly time, but I learned a lot from it. I definitely wouldn't change it for the world. And again, as you had mentioned, I think that we've really rebuilt the infrastructure in a very different way today. And the type of deals we invest in are debt loads on our properties, and we run different scenarios of kind of worst case scenarios. We do stress tests on all the properties we buy, assuming worst case scenarios to ensure that if if plan A doesn't work out, plan B, how's it look? Plan C, how's it work? Plan D, how's it working? And what's a worst case scenario? And are we still comfortable buying this deal, even in a worst case scenario? So, very different world back then, maybe some similar challenges, but not necessarily the same as what we're facing here today. But again, I learned a lot and tried to apply any of those lessons to, the world we live in today.
Well, this is a really incredible story, and it's something that I think is important for people to hear. And it's also just very much appreciated by me when whenever I have a guest on the show, or even I'm at a conference and someone's on stage. And oftentimes there's a perception of when you see somebody on stage or you see somebody on a podcast, that there's this perception of achievement and success and must be nice, probably easier for them. And so when you hear the real story of, the battle wounds and the scars that were endured on the way to where you are today, I think it's really empowering for anyone who could be feeling stuck or in a slump to know that everything is temporary. But there's a deeper piece of the puzzle here, which is, what did it look like for you? Like literally, how did you rebound? What did it
Yeah.
look like to rebound? But number two is like, how did you have how did you redevelop the confidence or the willingness to start to rebuild when so many people, if they lose their shirt in an entrepreneurial endeavor, they end up giving up and they say, let me just go get a steady, safe job. So but I feel
Yeah.
like with the entrepreneurial spirit, it never dies, right? Like there's an aspect of it that is like we're either born this way or we're not. It's a special kind of crazy. But I think it's important to know, what did the rebound look like?
I can only speak from my perspective. I mean, I honestly, I didn't, as I mentioned, I didn't go to college, so I didn't finish, community college even, so I don't have a degree, and I honestly, I didn't believe that there was ever a plan B for me. Like literally, I didn't feel like I was employable. I'd considered, going to work for like a commercial brokerage shop or something like that, and every time I, started having those thoughts, I just thought how, I just cringe, right? And like that's not for me, and it's not saying that's a bad thing. It's just not, it's not how I'm bred, right? And so I just didn't think there was another option. And there's an exercise, a pretty simple exercise that a good friend of mine, and there's a lot of people surrounding me that I felt were way smarter than I here in Florida, other investors that have been doing this for multiple cycles, that were, 20, 30 years older than I, that had a bigger portfolio, that also were going through the same thing, right? They had been crushed. And so, not that that made me feel better, but I didn't feel entirely alone, I guess I sobbed along with many, many others. But one exercise that a good friend of mine kind of helped me walk through, and he suggested I just do it on it whatever the days where I was feeling really down, because like a couple days would go by and I felt good, and then I'd get a knock on the door, and it was another process server, right, serving another lawsuit, and there was lots of them, lots of judgments, lots of lawsuits, so lots of things. It didn't just happen like overnight. Like it just was drawn out over like a 3 year span of time, if not longer than that, really, until I really got my head above water. And so it was like a continual battle with like feeling good a couple days, and then literally getting pulled back into the trenches with another lawsuit, something else I have to address and deal with. My personal home is in foreclosure. I never defaulted on my credit cards, like personal credit. I had quite a significant amount of credit lines, but when they started seeing the defaults on the loans, obviously all the credit companies saw that as a risk, and so literally every single one but my Discover card completely shut off. Discover card took my credit limit from like probably 50,000 down to $500. So basically, I had no available credit to my name. My credit score was shot, and then one of the banks penetrated one of my personal accounts and actually garnished all my literally all the remaining funds I and down to a negative, out of my personal account. So, um, but my friend had me go through this exercise. He's like, okay, so you think this is worst case scenario? Like this is pretty bad. Like you're literally you've got a what a 480 credit score now. You've got a lot of lawsuits that you're going to have to work through. You don't really have any money to deal with them. You don't really have any personal funds. You still have a roof over your head. You know, the foreclosure process is a little delayed in Florida. It's backed up, so I wasn't necessarily at risk of losing my like the roof over my head right away. But he's like, you got both your limbs, you got your health. You still have friends around you. You still have family that loves you. You still have people that are like, even if you lost your home, like, could you go find a place to stay? Would someone let you crash on a couch? The answer is like yes. So it's like when you start going through that exercise, like how bad is it really? And then whenever you get to the answer of like, this is as worse as it could possibly be, well, then you realize that there's millions of other people in this world that literally is their day. That's their day in, day out. Like probably much worse than that, right? And so it really helps you kind of reset your mind of like this really isn't that bad. Like I've literally have all the means. I've got my brain, I've got my health, I've got the means to actually get out there and fight another day. And so I'm not going to say that was easy. And I went through exercise for years, and there was definitely darker days than others. But I'd say the big thing that really helped me, in addition to exercise, was health and fitness. I was always into it. I'd always go to the gym, and I'd try to eat healthy. You and I talked about this a little bit before we started the interview, but I really embraced it. It was the only thing I could control. Everything around me, I literally couldn't feel. I felt like I was out of control. But the one thing I could control is actually how I felt physically when I woke up in the morning, and having a clear mind, to kind of think through these challenges I was having really helped me through those darker couple of years. And so, I mean, I just really got on a health kick. I'd work out 7 days a week. I started doing long distance cycling. I even started a charity built around that just, helped me kind of fuel what became a passion into giving back to others, even when at this time when I didn't really have the financial means to give back to other people. That really helped me. In my mind, I didn't have a plan B. Like I had to find my way and fight my way out of this corner. And so, again, it took a number of years to do that. And I didn't really feel I wasn't ready to really get back into it. I don't remember what the spark was, but probably like mid 2011. So, roughly 3 years after is, I don't know, I just woke up one day. I was like, I think today's the day. I don't know what it was. Just today's the day. I think I need to start getting out there and finding out what this new landscape looks like. Cause I was kind of stuck, buried in my own little bubble. I'm ready to get back into it. I mean, there's still people out there doing deals. Let's go talk to them. Let's find out, how they're doing deals, how they're making money, and that's ultimately what took me on the path to kind of re-envision myself, and it's what took me on the path which led me to a guy by the name of Randy, which is an individual that turned me on to mobile home parks, which is what the asset class that we buy today. And so, but yeah, it was tough, Aaron. I mean, it was a tough couple of years. I mean, really, really tough. During that period of time, literally right before we defaulted on there, this is an interesting part of the story. This is '08. I had beautiful home on the Gulf of Mexico. All the things, right? Like, and life was good. And I had just met a girl by the name of Joanna. We'd been dating for like, I don't know, 2 months, 3 months. And she happened to be in the banking world. She was in commercial finance. And so like she knew some of the struggles that banks were having, and nothing had hit the fan yet. Like, none of the major banks had failed yet, but it was coming. Like I felt the pressure. And I remember we had been dating for a couple months, and we were taking a bike ride, like down by the beach, whatever. And I remember I felt this like need. Number one, I felt like she was the right one. I was like, man, I feel something special here that I haven't felt in a while, but I didn't want to lead her down the path. In my mind, I'm like, this is not going to end well. I feel like I'm going to lose everything. Like I didn't see a pathway out. And so I told her that, and I was like, hey, I want to, I don't want to set you up for failure here. I think it's going to get pretty bad, And she was like, I think you'll figure it out. She didn't know me all that well, but she's like, I think you'll figure it out one way or another. I'm like, I don't know. I was trying to joke around about it, but really serious. Like this is not going to end too well. And all these things that we've been enjoying together probably won't have access to him much longer, right? And ultimately it did play out that way. But she stuck by my side, and I mean, we didn't live together at the time, we weren't married, but she really helped me through it as well, and helped me see the other side, and just never lost faith in me. Like, hey, like you'll get this. Just keep working through it. Keep working through these challenges. And you'll find your way to the other side. So, but she stuck by my side even after we went to about a week after that bike ride. We went to breakfast. This is when, or maybe it was a couple months after, went to breakfast together, and I went to get my truck washed at a place across the street. went to pick it up. And at this point, the bank had already shut down my credit cards. They had not garnished my personal account yet. And so I didn't have credit. All I had was a debit card. And so all I had was the money that was in my account at that point in time. And I went to pay for this like $15 car wash and it got declined. My debit card got declined. And I knew I had cash in there. But that's it, literally in front of her. I had to call the bank. So I was like, there's got to be something wrong. And it was like negative like 300 some odd dollars. So that's when it had gotten garnished, literally right in front of her. Kind of an embarrassing moment. But one, when I realized, I was like, I literally have zero money. I have zero. Like I'm negative. I don't know what I'm going to do. And she's still stuck by my side. So we're married today. We've got two beautiful children. And life is very different today than what it looked like back then. But she ultimately supported me in those challenging times. So,
I love
yeah,
that story so much.
yeah, yeah,
It's
yeah. So.
reminding me of when my credit card was declined for a $2 cup of coffee a week before our wedding. So
Yeah,
been there. Yeah,
it helps us
2008.
grow though. It helps us grow. I mean, it's life lessons and it just really, makes you humble. It's funny. My boys have heard the story. It doesn't click for them. They can't necessarily comprehend of what that was or how that felt or, not being able to, have the latest video game or whatever it is they have, it's just like, no, like you think about this home you're living in today, like that just vanishes, right? That goes away. Your car gets repossessed. Like, we're living in a hotel room maybe, and like that's how bad it could get, guys. And it's hard for them to fully comprehend and understand that.
For sure. So, okay, bring us to the present.
Yeah,
You made your transition into mobile home parks and parking lots and started
that's right.
buying. So, talk me through that journey also as it relates to how you operate Sunrise Capital Investments now, because I know that you have over 900 investors that invest with you. You guys are responsible operators for finding the actual assets, the land, et cetera. And you mentioned, I think you're in 12 or 13 states. So
Mhm.
give us a little understanding of the business model today and how it's created this level of stability and growth where you had your best years ever in 23 and 24.
Yeah, I mean, so to your point, we buy mobile home parks. We've been buying now since 2011. We also buy parking, garages, parking lots. We've been buying those for about 6 years now. So it's kind of a newer addition to our strategy. I took a lot of the things I learned earlier on. We always buy. We try to find motivated sellers that have good assets that just maybe have neglected them for a number of years. It used to be single family homes way back when, and today it's mobile home parks or it's parking investments to where we can go in and we identify a great asset in a great market, a market that has a high demand for affordable housing, which is the product that we provide, and to where we can go in and fix the broken elements. And most of the time, it's the market's not broken, the location's great. It's just that the current ownership or prior ownership just hasn't reinvested into the community for many, many decades. That's typically the case, or they don't run it like a business. And so we'll go in and we'll inject sometimes hundreds of thousands, sometimes millions of dollars of investment capital to improve things, road, new infrastructure, new signage, landscaping, new homes even, and basically reinvent what was a blighted part of a community and turn it into something that the community and the citizens are proud of and residents are proud of. And so that's our business model today. I mean, to simplify it, parking is kind of the same thing. A lot of parking assets we buy them from generational families that have owned them for 20, 30 years. These things are in prime locations. The one we just closed on literally is a block away from the Libertyville in downtown Philadelphia. Independence Hall is right around the corner. I mean, it's right in the heart of historical Philadelphia. There's a major shortage of available parking, but this asset had been run um, by the same operator for about 25 years and just over the last 10 years had simply neglected it, hadn't put money back into it, hadn't adjusted parking rates, hadn't made improvements. And so folks that had other options of parking would park other places and they wouldn't park there because the concrete's cracked or the lighting's not good. I don't feel safe going in here. And so we went, bought it at a discount. We're putting about $3 million back into it, and ultimately our overall all-in basis on this property, we bought it for I think 25 million. We'll put 3 million into it, but when it's all said and done, this property will be worth roughly 40 million in the next 2 years. So we do the same thing with mobile home parks. That's kind of our gist. Parking the same thing, and we like buying great assets in great locations at discounts that we can identify what the broken pieces are, and we can go in and fix them within a 12 to 18 month span of time, and again make it a better environment for everybody that's there, whether it's residents that are living there, parkers that are using our parking facilities, and everyone wins at that point in time, including the investors that invest in our deals.
So for anyone listening who is not familiar with true passive investing and
Mhm.
syndications, which I know many of the listeners are if they've been listening to this podcast for a long time, but what does it look like for someone who's like, whoa, 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 you're buying $25 million properties and putting 3 million in, like what does that even mean? And then if someone wanted to invest with you and be just having a piece of that pie, what does that look like?
Absolutely. So we basically we find the opportunities and we operate the opportunities, and then the funding. Normally, about 60% of it comes from equity investors, 10% comes from us, the sponsors, and then normally the other 30 or 40% will come from a debt lender, like a bank, traditional lending institution. And so, really, it's kind of simple. Lots of investors that are current investor of ours, they're professionals, like they're doctors, lawyers, business owners. They're busy professionals that have done really well in their career, and they want to diversify, they want to buy real estate, but they don't necessarily want to be actively involved because there's really two options. You can go out and buy your own property. If you've got the capital to do it, you can go buy your own property. You can go buy your own mobile home park and go buy your own parking asset. But guess what? It doesn't run itself. It's not passive. Someone's got to operate the day to day, and so you make the decision that, do you have enough time after your 9 to 5 to go operate this personal investment, or would you rather take the money that you've made and invest it passively with a group that's going to handle all the day-to-day operations? You still get a portion of the upside proportionate to your investment, but you don't have to deal with the day-to-day headaches. You don't have to become an expert in managing a mobile home park, managing the day-to-day operations of it, handling repairs and maintenance, things like that. So, and there's no right or wrong. I mean, what we have found is that actually a lot of our investors, a lot of them have actually started off by buying their own investments. They went and they wanted full control. They wanted to, make all the decisions. They go out and build a portfolio of single family properties. And then, maybe they own it for 10, 15 years, and they realize, like, this is an extra 15, 20 hours a week for me to run these. And it's great. I've done well and made good money, but I'm tired. I'm kind of worn out. Like, literally, I've worked my job for the last 30 years. I've got these investments, and like, they've kind of chained me down. Like, I'd want to find a way to, get more passive in my life so I can buy some time back in my day to day and go travel the world or whatever it might be. And so a lot of them have switched over from being active investors over to passive investors and put their money with us and basically yield a lot of times the same results, if not better results, but not necessarily have to do all the work. The only thing that you have to forego, being a passive investor, is at that point you're relinquishing control. You're basically relying upon us, an expert within our industry, someone with a track record, to make all what we feel the right decisions, the day-to-day decisions, the operational decisions. Whereas when you have your own investments, you can make those, whether they're right or wrong decisions, but you get to make them. You get to be accountable for every decision that you make. Whereas when you're investing with a group like ours, you're basically saying, hey guys, I trust you. I know who you are. I know the track record. I want you guys to do what you do best. Go do your thing and just send me a check every quarter that I can take and go again, travel the world, live the lifestyle that I so choose. So that's really the gist of it, in its simplest form.
So what is it about the mobile home parks that created such an upswing in 23 and 24 when the rest of the traditional real estate investing market was
Yeah.
starting to experience the decline?
Yeah, and that's a great question. I don't think it's not necessarily the investment vehicle, so i.e. the mobile home park that created the upswing. I think it was more of our kind of our strategy. So again, going back to what happened in '08. There was a period leading up to '08 where everyone had FOMO. If you didn't buy an investment property, you were going to be left behind because the values were going to continue increasing and it was never going to slow down. It was never going to stop. There was never going to be a reset. I'm not going to say I got caught up in that per se. I mean, because anything we bought, we still had a formula. We still had to buy at a low enough basis, but things did get overinflated. And, looking back and being realistic with myself, like there was periods of time, even if I was buying at what I felt was a discounted basis, it was still based on what I felt was an overly inflated top line price. And so it kind of happened, when rates went down in 2020, and then we found ourselves in this historically low interest rate environment. At least what I saw within our industry, when we were out there trying to buy property, we were getting outbid left and right. And we're pretty disciplined. I mean, we've got a buy box. You can make anything work on paper. You can run a pro forma and make anything work, but we're very disciplined buyers. Again, I wanted to, when we rebuilt the second time around, I wanted to be sustainable both in the up periods and the down periods. And so but to be honest, it got quite challenged to where those couple of years, late 2020, 2021, 2022, we found ourselves being outbid in the majority of deals that we would try to buy. And I didn't understand how others were buying them. Again, maybe they're smarter operators, they're better buyers, and maybe they got cheaper cost capital. I don't know what it is. I never figured out the answer until really rates started going up. And what I found is that, all those that were buying maybe got out in front of their skis a little bit, maybe overpaid for a couple of assets, to where now, their liquidity dried up. Maybe they stopped making distributions. They had to do capital calls to investors, right? They found themselves in a precarious state because they overpaid, or maybe they put less than desirable financing, like adjustable rate financing on these deals in order to make them pencil out. Whereas we didn't do that. I mean, we stayed disciplined. We bought deals that made sense, and we got beat out on the other ones that we couldn't make sense of. In fact, we actually sold a number of properties at what I thought were premium prices, kind of, cleaned out our portfolio a little bit, sold the ones that we didn't see, long-term vision in, and got, just top-notch prices for them. And so what that did is it set us up in a really good position when rates did start going up and people were starting putting, got put on the sidelines. They couldn't buy anymore. Guess what? We never stopped distributions with our investors. We literally have not missed a quarterly distribution in like 32 months, which is basically, the history of since we've been doing funds. And our investors continue to have trust in us, and basically it put us in a position where when deals did come to the market, there weren't many other buyers. We were able to basically get in and buy them at a really good basis and be just uber competitive and in an environment where a lot of our would-be competitors were off dealing with their other challenges that they had faced from the years prior. So it just, again, I think it just, real estate's a long-term game. It is. Anyone that wants to get in and try to make a quick buck, you can do that. You can have a couple, triples or even, home runs or grand slams every once in a while. It will happen. If the longer you're doing it, you'll have those. But really, it's a singles and doubles type of strategy. It's just about being disciplined, being honest with yourself, creating a buy box, and thinking about it in the long term. Like, this is not a one cycle type of investment. This is how do I make it through a multitude of cycles? And the only way to do that is be incredibly disciplined and stick to that, even when there's that FOMO period of time, because we had it. The internal struggle we had within our organization is I'm mostly on the buying and the operations side, and then my business partner runs the other division of our company, which is raising capital. And back in 2020, 2021, 2022, everyone's making money. There's a lot of, money being pushed into the national economy. People were spending money like crazy. There was, capital free flowing. And so we had no issue raising capital. In fact, we would turn away capital from investors. And that's really hard to do because if you turn away investor capital, it's going to find another home somewhere else. And so the internal strife we had was like, hey, Kevin, I need more deals. Well, hey, Brian, I can't make them pencil. So we're going to have to say no to, XYZ investor. They're going to have to go find another home for their capital. It's unfortunate, but like, it just is what it is. And so that discipline between him and I, not accepting capital when it was easy and readily flowing, really put us in a great state a couple years later. And so again, like, to your point, what you mentioned, we had 2023 and 2024 were record years for us. We acquired about $250 million worth of assets in those 2 years. And we're having another, it's turning out to be another incredible year this year in 2025. So, but again, just really tying it back to being a disciplined investor. And I think that's applicable to whatever type of investor you are, whether it's real estate or stocks, bonds, businesses, what have you. Just being disciplined and being true to yourself, and knowing that it's a long-term strategy.
I love it. Well, this has been awesome. I feel like I've learned so much, and I feel like it's leaving us all empowered to continue to dream and to explore and to know that there's always a way through and out and always ways to rise again if you are
Yeah.
feeling stuck in this exact moment that you're hearing this. Kevin, I know you've got a podcast, and if folks wanted to find you, learn more about investing with you, or just learn from you, share all the ways they can do so, please.
Yeah, sure thing. Investwithsunrise.com, best place to learn a little bit more about Sunrise Capital Investors. We've got a lot of resources on there. You can also listen to my podcast, which is Real Estate Investing for Cash Flow. But anytime we have an offering open, which we do at the present time, you can learn more about that on investwithsunrise.com. We've also put resources up there, and we're pretty transparent. So we've got deals that we've gone full cycle on. We provide third-party reports, appraisals, just to show you like who we are, what we do, kind of the business plan around it, and then what the end result looks like. So outside of that, my last name's kind of unique, Bupp, Bupp. And so I'm pretty active on LinkedIn. I'm active on Instagram. If you just type in Kevin Bupp, I'm pretty sure I'm the only one that comes up that's in real estate. So it shouldn't be too hard to track me down.
Awesome. Well, thank you so much for taking the time out of your schedule to be with us today, Kevin.
Thanks for having me, Aaron.
And to all my friends listening, as always, I love having you here. I appreciate your continued support. And if there's any takeaways that you've gotten from this, please reach out to Kevin or send me a DM at Pursuing Freedom Official. If there's topics you want to see more of on this podcast, please let me know because I'm trying to bring as much value as humanly possible. And if ever you want to connect in real life, then shoot me a DM and let's hop on a call because there are so many ways I can connect you to people like Kevin and others in my network that can help you on your journey to building a life you don't need a vacation from. I love you. I appreciate you, and I hope to talk to you soon. Bye bye.